What's going on, YouTube? In this video, what I'm going to do is explain how to use Fibonacci levels with candle range theory and give you a real-time example so that you can use Fibonacci correctly. Just for an example, right? Let's say like you draw your CRT high from here to here, right? What you would pretty much expect is you have it drawn from your high to your low, and then you're now anticipating the retrace somewhere within this Fibonacci retracement, okay? So your first level being 23.6, the way that you view a 23.6 level is as a continuation of price. So what I mean is if price comes down and respects the 23.6 level, all that is considered one bearish leg of directional movement, okay? Which means you don't really count anything that happens within this level at all. Now, let's say price continues further into the 38.2% area, okay? Now, whatever happens from this point is a valid structural point of the candles. So let's say you have your high to your low and you have a 38.2 retracement, and then the market respects that. That's fine. You can now target prices to go to the 0%, which is back to the low, and your targets being the, in my case, sometimes you don't like, these targets are not definite, but the way that I use them is my TP1 is always my negative 27% and my TP2 is always the negative 61%. Now, you don't always have to hold to expect price to come to these levels, but if you do, there's generally always some type of confluence within your candle range theory and the negative 27% and the negative 61% as far as target points. Okay. Now, let's say you have another example, right? Where price comes from the high to the low. Once again, it continues further up. And now let's say it taps between the 50 and the 61.8% areas, then continues lower. So now when it comes to this, you have to always understand the context of what it is that you're generally seeing in the market at any given point. Let me just draw this a little bit just so you can see the full momentum of the candle. So a 61.8% is generally a very strong reversal point. But when it comes to trading CRT from these areas, okay, you never want to assume that these areas is going to cause a rejection. You're going to always want to watch how price forms at these areas only, okay? Because there will be some occasions where, let's say, for example, you have a 38.2% retracement, right? It comes down, let's say it respects that area. I'm pretty sure this happens a lot. So just watch how I'm going to explain it, all right? Now, let's say price comes back up into that area, touches the 61.8, and then it continues lower. But a lot of people, what they will understand is within this area, what they're going to do, if they're going to see that this 38.2 level was broken, they're going to assume it was a break of structure. And you know what they're going to do? They're going to ignore the fib, and then I can't even find it right now. And then they're going to get in buys because in their mind, okay, what happened was a break of structure. So now we're looking to go back up. In reality, that's the case sometimes, but all times it's not the case because the use of a Fibonacci is particularly to track retracements. It's not supposed to be used to track breaks, but more so retracements. So within this area, let's say like we're on the 4-hour time frame, I guarantee if you go to like the daily time frame or something within that area, this break of structure would not exist and it would just be a wick from the 61.8 scenario. So now pretty much with the 61.8 scenario, and you could even go higher to the 78.6 and the 88.6, what these areas are there just deeper liquidity hunts before the final retracement point in the market. So CRT shows you how the candle reacts at the level, not just if it touches it, but you're looking to find the type of reaction that forms and then going along with that as structural confluence. Okay. And another way that you want to apply CRT when it comes to Fibonacci levels, and this is most likely the most important way. Okay. When you have a Fibonacci level within a CRT, when you draw between, in this case, you want to always draw from the candle low to the candle high, and then you want to mark your 50% level. Okay. Your 50% level from the CRT perspective, right, is going to be a decision level for, let's say you're in a trade, whether or not to hold it from that level to go break even or to take out your trade, et cetera, et cetera. It is a level that you need to now make a decision from to, determine just what you're going to do next with that trade from that point. Now that I pretty much briefly explained that, I hope it was good enough. I'm going to just clean this chart up and then go into depth on how to use Fibonacci from the perspective of CRT. So first things first, now as I look at this area, I see we are in this here, this downward move of distribution. Okay. So when it comes to applying your fib, you always want to apply it from a swing high point to a swing low point. And what I mean is you will use this bearish candle high and put it at the bearish candle low. So what you would have is a point A and you will have a point B. And what you're trying to look for is your point C. Okay. You're always looking for your point C. So you have your A, you have your B, and you're looking for C. As in this case, as you can see, soon as price got to the 50% level of this distribution leg, right? What you actually have is a bear CRT setup forming with, you can use this high here, the low. Understand the context. A bear CRT candle will always be bullish, okay, which is exactly what this started from. And then now you're understanding that you're seeing that we're having a rejection at this 50% level. So now with this understanding, you can set your targets. Overall, you always want to go based off of the candle itself first until the momentum picks up, and then now you can ride with the market. But first, you always want to have this. So if you had things, your A, your B, you're now identifying your C level. You can even zoom even closer now. So just for this quick example, I'm going to take off the A and B. And so now what you're going to want to do is get this. You're going to want to get the 50% of the candle that you're using. Okay. So what I mean is, I think I just picked the wrong thing. So what I mean is you have to have your high and now your low from this specific candle only, right? And like I was saying, the 50% is your decision level. Why? Look at what price did. Okay. Price came near this 50% and retraced, because on a lower time frame, price retraced, kept going higher, went back up, but ultimately stayed within the range overall and targeted our first level, which is always going to be the 0%, which will be the low itself. And then you will have a TP1 negative 27%, as you can see. And then you have a TP2 at negative 61, where you could have held it lower just within this candle range itself. Okay. And on a lower time frame, which you're going to have, you're going to have a smaller version of accumulation, manipulation, and distribution. So just so you understand what you're seeing, what I like to always do is I like to always use the numbers, because it just helps you put things from a sequence perspective, right? 1, 2, come back down, 3. Oh, 3. There you go. So now you have your accumulation, manipulation, distribution. And as you can see, when I zoom out, so that's the scenario that you want to have from the candle itself. But from the market perspective, let me go back. I don't know what I just did. From the market perspective, okay, like I was saying, you're going to have your swing point from your your point A, swing point from your point B here, and then point C. And now you can have your first target being at 0%, as we just did from the candle. You're seeing how the market is fractal. So you're seeing the same CRT form, but now you're applying CRT context, because here's the juice, right? CRT captures the natural behavior of the market, but guess what? So does Fibonacci. So when you put them together, you're getting a clear view of what's actually happening based off of the chart perspective with the candlesticks. And then you have the more science-based perspective from the use of Fibonacci. So as you can see here, price pretty much almost came down to the negative 27%, but it did not. So just to clarify here, you have no break. All that you do is you do this, right? You start over now. So if you have that, if price comes back to the 0% from that point, because you already got your A, B, and C, you use a brand new Fibonacci. Okay. You don't have to have these labels no more. So let me take these away. So now what you do, you start a new fib. You start with your bearish high to your next bearish low. The first bearish low was this low here. So this is what you use to track that first retracement. What do you have? A negative 23.6%. So if you paid attention to what I said earlier, a negative 23.6% is just a continuation of one move. It does not count as a break of structure. So if price comes above this area, it meant nothing because that move was never strong enough to signal a break of any sorts. So, but what you will understand is now you're entering the realm of a deeper pullback. Okay. You're entering the realm of a deeper pullback. So, when you look at this from this same perspective, let me just draw this out. So, once your CRT comes above the 23.6%, all you do is you drag your 0% down lower to the most recent swing point, which was this bearish candle here. You now have a new range of Fibonacci, and these levels that I have on my Fibonacci, they just work perfectly. I'm gonna just be honest. So what I mean is, look at how I have them, right? Well, you have your 100% level, which is the max level of the range. So if you were drawing your swing high and swing low points, let me just draw that for the view, right? Let me make this a little thicker so you can see. Swing high, your swing low points. Is this thick too? It's not thick enough. All right. Well, yes, it is. It's cool. It'll work. So look, you have your swing point A, swing point B, and you're looking to find your C. So in this particular scenario, price broke past the 23.6 was not a sign of a break of structure. Remember that. It continued higher. It's still retracing 61.8. This is exactly why you don't try to trade them ahead of time, because just because it reaches a level, it does not confirm that it's going to reject from that area. It continued higher, showed a little rejection at 78.6, but it ultimately was not rejecting from that point. It continued higher. Now it's beginning to enter the extreme levels, which is the 100%, which is the equal high point level. And then you have your 110%, which is just like my level that's like, okay, this pretty much, well, this Fibonacci level is almost breaking. Now, once it's fully invalidated or come close to it is when then you hit the negative 120%, which is why I have it a red level overall, because this level signals peak Fibonacci retracement zone. So what I mean is, if it continued behind this, it's a complete break of structure, and you should completely shift your direction of focus. But what I'm going to do now is I'm going to actually clear this up so much more. So I'm going to show you what to do within these type of scenarios, right? So what you do when you have like a 4-hour Fibonacci and you're trying to track the retrace, and you might think that you're having a break of structure or not, you want to be able to confirm this. How do you confirm this? You see less noise by going one time frame higher. So you go to the daily and look, what do you see? Now tell me, does this look like a break or no? The answer should have been no, because you see, all of this was just wicks. All of this was fake outs. All of this was just manipulation, and that you're back within the CRT Fibonacci playing out because of the higher time frame. So then you will understand that, okay, this is actually not a break. We're actually within a daily time frame CRT within a Fibonacci context of maximum expansion. Not maximum expansion, but maximum exhaustion. Okay. Because now, if this candle closed, that would be a break, but it wicked all the way out. So let me just go back to the 4-hour time frame. Which you should be able to notice is you have a higher time frame CRT cycle of accumulation, manipulation, and distribution. Yes. So I'm going to draw this out now, right? If you've been following, you should know exactly what I'm about to do. Not that. Okay, what I'm exactly about to do, that. Oh my goodness, why are they setting me up like this? There you go. Thank you. You have your 1, which is accumulation. Now you could have your 1 and 2 levels within this case. I'm going to take this away so you can just see the phases of price, right? You have your phase 1, you could have put here, and then you could have understood phase 2. You're waiting for the peak manipulation to end. So you just will watch what happens. Watch how this candle forms. Watch how the next one forms. You see bearish momentum. You understand, okay, the peak is beginning to happen. So, but you don't fully enter the next distribution until price comes back underneath that area. And now you have your accumulation, manipulation, and distribution cycle. Okay. Now, as you can see, I drew it out both from a candle perspective and a market view of the phases as well. So you can align yourself with the directional momentum of the entire market itself. Now, let me draw the Fibonacci back so that you can see how you could have used this to actually help you set your targets, right? You will still have the same Fibonacci level when you're within all of this bearish movement. Okay. You're going to put your first target always going to be the 0%. In this case, it would be here. So let me make that a bit clear. And so your secondary target, like I said, will be your negative 27%. This is always TP1 officially when it comes to the Fibonacci. And so as you can see, right, let's say you entered all the way up here if you wanted to. I wouldn't recommend being in this unless you were completely swing trading. But, well, I wouldn't recommend doing it this way because I'm pretty sure you can find a CRT here on the 2-hour time frame and get a perfect entry somewhere around here and then pretty much hold with no problem. But I'm not going to go too much into that because what you will pretty much see is a smaller CRT cycle. You will have a 1, 2, and a 3 that's very much smaller, that's within the larger cycle of 1, 2, 3. So just to pretty much help draw it out, maybe this helps. Let me see. All right, you have another one. You can use that same tool, which is showing confluence within this area. Okay. So now you have a larger accumulation manipulation distribution within a smaller accumulation manipulation distribution from a smaller time frame. And then you're riding the wave. So as you ride this wave now, right, you're going to target, if you were looking at this from a swing trading perspective, was you target your TP1 at 0%. Or you like your first area, which is just a regular liquidity collection, and then your negative 27% is you're trying to capture and get a little bit more out of the move. Okay. So the market won't always come to this negative 20% perfectly like it did in this example, but in this example, it did come perfectly to this area. So once price comes to this area, and let's say you take out your trade, that's the hit, it hits TP, you can now take off your fib because now you're done and you're starting over from a fresh point. And your fresh point now would be from this now being your swing A, okay, to your new swing B here. So how you would do this in the moment, well, you would actually have this here, right? You would have a negative 23.6. Like I said, this area does not count as a structural area of a higher or low. This just shows momentum. So once price comes back underneath, you drag it down one more time, get that new area. And so pay very close attention to this because this is sauce right here. All right. A previous 23.6% almost always, I won't say always, but it has a high probability of turning into a 38.2% area, which is much stronger, like you see here. Okay, I'm going to draw the rectangle to carry this over. You had your first area, the first time price was here, it was a negative 23.6. Once it came back from the larger perspective, it became a 38.2, which showed that this area has a lot of bearish momentum within it. And you can technically count it as a point of structural resistance. Okay. So now, once you have this area, you can draw out your Fibonacci more. Okay. And then, so now you pretty much want to look for price within that area. So as you see, once price came here, you had a CRT. What do you have? A 4-hour bullish candle, swept the high, came to the low, collected that. You could have had your 50%, and that could have been a valid trade on itself just within this little area. Or you could have held because you understand that your entry is pretty high. If you want to swing trade this, you can. Or you could have just exited, waited for a cleaner entry. And let's see if you would have got one, maybe on a smaller time frame somewhere. You see that price is still rejecting this area. Not really. I'm not really seeing. Let me see what the daily had very quickly. You had this break of a high, but I'm not really seeing a clear area that really shows a secondary clean entry opportunity. Obviously, there were more entry opportunities, but your cleanest one was always this first one that happened at 9 a.m. on Friday. And this is exactly why you shouldn't have held it in the first place, because it's a Friday, right? And it does what it does. And then around Wednesday, what's this? Wednesday pre-London to London session, the full move began to take back into effect. And then you start to see price now head to your targets. So what happened? Price came to your 0%, which would just be a regular area of liquidity being collected at the lows, right? This is just regular sell side liquidity, et cetera, et cetera. Now you're trying to get more out of the market. It comes down to a negative 27%. As you can see, price did come into this area, give a small retrace as people began taking profits. But what happened? In this case, I cannot make this up. I didn't even know that this would line up so perfectly before making this video. You would have a negative 61.8% touch, which is the maximum level you can expect from a Fibonacci trade. It doesn't happen all the time, so it's not recommended to always hold here, but it does happen. So given the situation and the context of the market at this given time, you could have decided, okay, I want to hold even more, right? You could have probably scaled your trade, placed a stop loss somewhere, your entry somewhere up here, and just ride it along. It end up hitting 61.8, get out, and there you go. You would then have the maximum Fibonacci, and you would have used Fibonacci correctly from the lens of CRT and also just from the market overall, so that you understand how to use Fibonacci with it as a tool. Okay, you don't want to become over reliant on this, but it is a good tool to understand the market and its context. So now, before I wrap up this video, I'm going to give a few quick definitions for the actual candles range, the true high and low, and how to utilize the Fibonacci retracement with the CRT lens. And then finally, candle confirmation. So first, candle range. The full range is wick to wick from your origin points, okay? Which is, like I said, your point A to point B. That's what defines the structural shift with a strong body close, but you always want to go based off of the strong body close. Then you will have your true highs and lows within this area. This is the points that mark the structural range and determines whether price has broken or retraced overall. And then you have your Fibonacci retracement itself, which is to be used as trying to find your point A, B, and you're trying to find your point C, which is when the market is beginning to go back into the initial direction, or in this case, the initial distribution, right? So the way that you use that is you use that as a tool for measuring how price pulls back within a structural range, interpreted through the candle behavior, not just random touch points. Okay, and finally, candle confirmation, which is you want to look for a strong close in relation to the fib level that tells you whether it's a continuation or a rejection. And like I said before, you want to look out for fake outs by going to higher time frames and seeing if that area of rejection is a true break, or is it just a wick from a higher time frame that will retrace and respect the Fibonacci. So that will be it for this video. If you find this video useful, help open your eyes, make sure to like, share, subscribe to the video, and I'll see you on the next one. Peace.